Today, I'm sharing the 5 best ETFs that can make you rich. Oh yeah. Couple questions. First, do you want to find a way to build your portfolio up to $1 million or more, but you're not sure where to begin? Number 2, do you like the idea of being wealthy and not having to worry about money? And number 3, do you want the freedom to be able to work if you want to, or have the option to retire early? Well, if so, get ready for today's video. ETFs are like these mini rockets that are going to take your portfolio to the moon. You ready to go to the moon? If so, don't be dumb. Tap the thumb on this video and let's get started. So here's the deal. If I was 18 years old and I figured out a way to make $1,000 and I took that $1,000 every single month and I invested it into one of the ETFs that I'm talking about today, from the age of 18 all the way to the age of 38, only 20 years, I would have grown my portfolio balance to $3.1 million. Why didn't I learn about this in high school? Now, if you're new to investing and you're not really sure what an ETF is, let me explain it. Now, first, there's a lot of talk about index funds, and a lot of people like to associate index funds with mutual funds, and that's not always the case. You can have ETFs that track an index just like a mutual fund, and therefore is a passively managed index fund. What that really means is I think that ETFs are a little bit easier and cost a little bit less than a mutual fund. In fact, I broke down a video explaining the difference between a mutual fund and an ETF. I'll link that video up above so you can check it out right after this one. But an ETF, otherwise known as an exchange traded fund, is like buying a basket of stocks, not just an individual stock like an Apple or an Amazon or a Google, but having a basket that contains a little bit of each one of these type of things. It actually reminds me of a trip we just took a couple months ago to the Crayola factory in Orlando, Florida. And after the Crayola Experience, we looked at this wall in the retail shop, and this wall was filled with all kinds of different colors of crayons. You name it, pretty much every color that you can think of was on this wall. And you could go through and pick out your favorite crayons, pick out your favorite colors, whatever that would be. But think about those crayons as individual stocks. Sure, you can go through and you can buy each one of them individually, but they might cost more than, in this case, right across the store, there was a Crayola box. And in that Crayola box included a small sample of every single color that was on the wall, and it was less money. So the ETF is like the Crayola box. You get all of the different colors of the crayons, otherwise known as the stocks, in one simple share of the ETF. But it still has some phenomenal growth, which I'm about to share with you in just a moment. So in the 5 ETFs that I'm sharing with you today, we're gonna look at their growth, we're gonna look at how much they cost, and we're gonna look at the future potential. And stay tuned to the end because I'm bringing up a calculator. And on this calculator, no matter how old you are, we're gonna put one of these ETFs to the test and see if you invest money, what that future portfolio could look like based on its past trend. So let's talk about these top 5 growth ETFs. Now they have some criteria. Number 1, they have to, at least in the last 10 years, beat the S&P 500 average. That S&P 500 average over the last 90 years has been 10% growth. Number 2, we want to make sure that they have a lower expense ratio, even for the fact that they are passively managed ETFs. Lower the better, so at least 0.45% or lower for their expense ratio. Number 3, we want to make sure that their tracking average is right on point with whatever index they are tracking. Now, if you're not too familiar with that, I did a video on how to analyze an ETF, and I break down the tracking comparison in a little bit more detail. If you want to check that one out, I'll link that above in the video card for you to check out after this video. And last but not least, number 4, they need to have generally a lower turnover rate. We don't want to see them turning over all of their holdings. Typically less than 10% in the last year is what we're looking for here. Keep in mind, if you have an ETF that is turning over a lot of holdings, a lot of different stocks, that could actually come with added tax liability. Yuck. We want to avoid that when we can, especially for these long-term holds that we're talking about today. Let's get started, right? Let's go on with number 5 on the list. Here is number 5. It's ticker symbol QQQ. That's right, QQQ. It is an Invesco fund formed in 1999. And this particular growth ETF tracks the NASDAQ 100 index and has successfully stayed in line with that particular index. It's done a very good job. And let's talk about the performance of QQQ. This is really good. In the last year, it's 68.92%. In 5 years, 24.95%. And in 10 years, 19.91%. Just imagine that, guys, 19.91%. Let's just call it 20%. That's phenomenal. And that beats the S&P average by 10 percentage points. Awesome. QQQ is what that's all about. They have a total of 102 holdings because, of course, they're tracking the NASDAQ 100, which has a typical amount of 100 holdings, and their expense ratio is only 0.20%. But just stay tuned because this is actually the highest expense ratio that we'll talk about here on this video. But not too bad, and only a 7.6% turnover. Number 4, and this one you may be familiar with because we talk about this one a lot, and it's ticker symbol SPY. SPY, and here's a fun fact. It was formed in 1993, and it was actually the very first ETF to be listed in the United States. So this one is the grandparent of the group. Focuses on tracking the S&P 500 index, and check out this growth at 56.21% in the last year, a growth of 16.15% in the last 5 years, and a growth of 13.78% in the last 10 years, of course beating the S&P 500. The expense ratio is only 0.09%. We're not talking about 9%, I'm saying 0.09% is the expense ratio on SPY, and that's what makes this one so attractive. It tracks the index within 1%, it has 507 total holdings within this particular ETF, and only a 2% turnover. That brings us to number 3. And this one is VTI. This is a Vanguard fund, and it tracks to the total market index, specifically the CRSP US Total Market Index. Check out this growth at 62.72% in the last year, 16.66% in 5 years, and 13.79% in 10 years, with an expense ratio, get ready for this one, 0.03%. We're talking about pennies on the dollar. Has a total of 3,792 holdings. The reason that's so high is because they are tracking the US Total Market Index, which has a lot more holdings than your S&P 500 or your NASDAQ 100 that we just talked about, and only an 8% turnover. Now, I actually just invested in VTI within the Public app. Now, the Public app is a great new app that I've been using, and don't worry, I still use all of my other brokerage apps as well. But what makes Public so cool is that it merges the world of social media with investing. What's really cool is you can follow famous celebrities or people that you know, or great financial people. You can actually see what other people are up to, and at the same time, see what they're invested in. Best part is it does not route your order flow to hedge funds. So I've been focusing on building my portfolio, specifically with VTI in the Public app. Get yourself started with a free stock simply for signing up for Public. Link down below in the description. Let's move on with number 2 on the list, and this one is very similar to VTI, another Vanguard fund named VOO. Now, VOO was formed in 2010, and this one tracks the S&P 500. So you have VTI that tracks the US Total Market Index, and VOO tracks the S&P 500 specifically. And check out the growth on this one. 56.33% in the last year, 16.26% in 5 years, and 13.87% in the last 10 years, at an expense ratio of only 0.03%, total of 508 holdings, at only a 4% turnover. Now, I'm not saying that VOO is better than VTI, because remember, they're kind of two different things. You got the total market index, you got the S&P 500. These are both great ETFs. In fact, all 5 of these obviously earn the right of the best 5 growth ETFs. That's why we're talking about it here on the video. But I think that's something to keep in mind. Is it worthwhile to maybe have a little bit of S&P 500 and a little bit of total market index and a little bit of international? Hey, the more you can diversify, even with ETFs, the better for the long term. But you know what this means? It means that we have made it to number 1 on the list. Number 1 on the list goes to SCHX. This is a Schwab fund formed in 2009, and it tracks the Dow Jones US Large Cap Total Stock Market Index. Check out this growth at 59.56% in the last year, 16.7% in the last 5 years, and 13.94% growth in the last 10 years. Even better yet, beating out some of these other ones, since the inception of SCHX, they have seen a 14.9% growth since the day they started. Their expense ratio is in line with the Vanguard funds at only a 0.03%, again, pennies on the dollar, and they have 770 holdings with only a 5% turnover. If you just stay with the consistent and buoyant trend, what will happen is over a long period of time, you're gonna look back and be like, oh my gosh, I'm a millionaire. And I'm about to show you why. Hey, you might wanna sit down for this one because it's gonna get serious. Listening to my own advice, I am gonna sit down, but I wanna share with you a simple calculation that could potentially blow your mind. What I wanna share with you is an investment calculator, and we're gonna plug in some figures to this calculator. Now, I'm gonna include a link to this particular website in the description of this video, because Smart Asset, I think, has just a phenomenal, easy to use calculator here, and that's what I'm gonna use to base on our assumptions. But look at this, we're gonna start with $1,000. Let's say grandma gives you $1,000 for your birthday or for Christmas or something like that. And instead of blowing the $1,000 on something dumb, you're gonna start off your investment portfolio with $1,000. Then I'm gonna stretch you and say your goal is to have an additional contribution every single month of $1,000. That's right, figure out a way to get $1,000 a month. Side hustles, lowering your expenses, figure out a way to build up $1,000. Don't just rely only on your job income. We're past that. On this channel, we're looking at all kinds of different avenues to scale up our income. And while we're doing that, while lowering expenses, we can throw it towards something like this. Hang out with me for a second. You're about to see why I say that. So we're gonna do $1,000 a month, but the rate of return, I'm gonna say it's 19.91%. The reason I'm choosing that is based upon the 10-year trend of ticker symbol QQQ that we talked about at the first start of this ETF video. So 19.91% and 20 years to grow. Now, why I say 20 years? If you are only 18 years old and you're watching this, you're about to see what happens when you turn 38 years old. And remember, 38 is still young. 38 is nowhere near the average retirement age of like 65 or 70 years old. And you're about to have so much more. But if you're not, let's say you're 40 years old, 50 years old, 60 years old, it doesn't matter. I don't want you to sit here and think, oh, I guess I missed the boat, I'm stuck. No, because think about it this way. If you're 48 years old, by the time you're 68, you are gonna have more money than all these other friends that you have that are 68 years old. And some of them might still be working because they have to. But because you figured out a way to either scale up your income, reduce your expenses, or both, and put $1,000 a month into this fund, into any of these funds, check out what happens. Assuming a rate of return of 19%, you are gonna have a balance of $3.1 million. That's why you have to sit down for this. 3.1, and think about it. If you started this, and I know we don't make a lot of money when we're 18 and 19 and 20 and 21. I get all that. But get out of that crappy mindset. Figure out a way to get $1,000 a month. I know it's hard, but figure it out. Because if you do, 3.1. Heck, even if you cut it in half, you're still going to be high up on your money in 20 years. Think about that. Look down here. This is what's also awesome about this particular website. If you scroll down here, you can see, of course, our starting amount at $1,000. You can see our total contribution was $240,000, but check out the interest, AKA the growth of this particular deal, $2.8 million. You earn $2.8 million by not buying a brand new car and putting $1,000 payments on it. Instead, you're putting it toward this and you're growing it. Stop chasing the hype stocks. Stop chasing the meme stocks. Stop trying to get rich overnight. Because eventually, in 20 years, I bet if you look at the people that are constantly chasing the lottery tickets versus the people that are being consistent with their game plan, I think the people over here are going to be so much more well off. In fact, they're going to have potentially a couple $1 million, as opposed to somebody that has been trying and trying and trying, and they think this next hot stock is going to be the one. That sounds pretty awesome, doesn't it? If you enjoyed this video, like it. Here's another video that can help you, and this video is a video that YouTube thinks you're going to like. But until next time, we'll see you in the next video and continue to live your sweet life.